On January 29, 2026, the global financial landscape witnessed a phenomenon that hasn't occurred in nearly 100 years. Gold prices shattered records, reaching an astonishing $5,595 per ounce. This wasn't just a minor fluctuation or a typical market rally. It was a seismic shift that caught the world's attention. While the general public marveled at the price tag, major institutions like J.P. Morgan, Goldman Sachs, and Bank of America began projecting even higher targets, suggesting that $6,000 or $6,300 could be hit before the year concludes. However, the price itself is merely the surface of the story. Beneath the numbers lies a specific economic signal that has appeared only twice in the last century, once prior to the Great Depression and once before the stagflation crisis of the late 1970s. In 2026, this warning flare is back, and it is brighter than ever. To understand the magnitude of this move, we must look at the data from the preceding year. In 2025, gold surged by approximately 60%, marking its most significant annual gain since the 1970s. For comparison, a $10,000 investment in gold at the start of 2025 would have grown to over $16,000 by the end of the year, outperforming stocks, bonds, and real estate. This momentum carried directly into 2026, with the metal crossing the $4,000 and $5,000 thresholds in rapid succession. Although it has recently settled into a trading range between $4,700 and $4,800 after the January peak, analysts maintain that the long-term trajectory remains aggressively bullish. This is not a simple story of supply and demand. It is a story about the fundamental health of the global monetary system. The hidden ratio: gold versus paper money. The most critical metric currently sounding the alarm is the ratio of the total value of global gold to the U.S. money supply, specifically M2, which includes cash and bank deposits. Historically, this ratio remains low because modern economies thrive on credit, bonds, and paper currency. Gold typically remains a quiet, secondary asset. However, there are rare moments when this ratio explodes upward, signaling a mass exodus from paper assets into physical, unprintable wealth. The first time this occurred was in 1933. During the Great Depression, thousands of banks failed, and unemployment skyrocketed to 25%. As trust in the financial system evaporated, people turned to gold. The government's response was drastic. President Roosevelt signed Executive Order 6102, effectively criminalizing the private ownership of gold and forcing citizens to sell it to the Federal Reserve. Immediately after, the dollar was devalued, and gold jumped from $20.67 to $35 per ounce. Those who held gold were shielded from the currency's collapse. Those with cash in the bank saw their purchasing power vanish. The second instance was in 1980. By this time, the U.S. had fully abandoned the gold standard, leaving the dollar backed only by government trust. That trust fractured when inflation hit double digits, reaching 14.4% in 1980. Gold prices went from $35 in 1971 to $850 in 1980, a 2,300% increase in less than a decade. It was only after interest rates were pushed to 20% that the dollar stabilized and gold prices retreated. The lesson is clear. Gold does not rise randomly. It rises when the monetary system is under extreme duress. In 2026, the gold-to-money supply ratio has surpassed both the 1933 and 1980 levels, even while the economy appears stable on the surface. The fiscal trap and the national debt. A primary driver behind this current surge is the staggering reality of the U.S. national debt. As of March 2026, the debt has surpassed $38.86 trillion. More concerning than the total debt is the cost of maintaining it. For the first time in history, the United States is spending over $1 trillion annually just on interest payments. This is money that does not fund infrastructure, education, or defense. It simply services old debt. Even with the Federal Reserve cutting rates to the 3.5% to 3.75% range in late 2025, the debt-to-GDP ratio remains above 120%. Economic research suggests that once a nation's debt-to-GDP ratio stays above 77% for an extended period, economic growth begins to slow significantly. The U.S. has been above this line since 2008. This puts the government in a fiscal trap. To fight inflation, they must raise interest rates, but doing so increases the interest burden on the $38.86 trillion debt, potentially leading to a fiscal crisis. To ease the debt burden, they must cut rates, which risks reigniting inflation. Gold is currently pricing in the most likely outcome, a gradual devaluation of the dollar. By allowing inflation to stay slightly above the 2% target, the government can pay back its massive debts with cheaper dollars, effectively shrinking the debt's value at the expense of the currency's purchasing power. The Great Central Bank Pivot. What truly distinguishes the 2026 rally from previous eras is the behavior of the world's central banks. For decades, these institutions were net sellers of gold, preferring to hold U.S. treasuries because they paid interest. However, in 2022, a tectonic shift occurred. Central banks began buying gold at a rate exceeding 1,000 tons per year, more than double the historical average. This trend accelerated into 2025, with global demand hitting record highs. Nations like China, India, Poland, and Turkey have been leading the charge. Even more telling is a milestone confirmed by Morgan Stanley. For the first time since 1996, gold now accounts for a larger share of global central bank reserves than U.S. treasuries. The world's most sophisticated financial managers are choosing a non-yielding physical asset over the debt of the United States government. This is a profound statement regarding the perceived risk of the dollar. Gold carries no counterparty risk. It cannot default, and it cannot be printed into oblivion. By shifting their reserves, central banks are signaling that they no longer view U.S. debt as the ultimate safe haven. The liquidity cycle and future outlook. The current environment is further complicated by the massive influx of liquidity that began in 2020. Although the Federal Reserve attempted to tighten the money supply in 2022, liquidity began rising again in 2025.
In 1933 and 98, gold served as the ultimate insurance policy against a banking system. In 2026, the signals from the gold to money ratio to central bank behavior are lower than they have ever been. History suggests that the market warning us of the major minority and transitions Whatever, whatever this results in a sudden crisis or a prolonged period of the currency devaluation remains to be seen, but the message from the gold market is clear. The era of the paper-based certainty is facing its greatest challenge yet. Understanding these underlying machines in this only to way negativate the volatile decides the ahead.